$90 billion exposed in 6 months. That is how much Michael Saylor's company just lost in market cap, more than the entire value of Ford Motor Company, nearly double what FTX had when it collapsed. And here is the part that should terrify every Bitcoin holder on the planet. Saylor owns 672,000 Bitcoin. That is 3.2% of every Bitcoin that will ever exist. And in 11 days, a single decision could force him to sell. January 15th. Mark that date. Because what happens next could be the biggest forced liquidation event since FTX. Let me show you how we got here. In July 2025, strategy stock hit $450. Saylor was a genius. The Bitcoin treasury model was the future. Everyone wanted in. 6 months later, the stock is at $151, a 66% collapse. But here is what makes this different from a normal crash. Bitcoin only dropped 25% in Q4. Strategy dropped 53%, more than double. That is not correlation. That is leverage unwinding. And when leverage unwinds in a company that holds 3.2% of all Bitcoin, everyone holding Bitcoin needs to pay attention. So, what actually happened? Strategy built a machine: sell stock, buy Bitcoin, repeat. The idea was simple. Investors pay a premium for strategy shares because they get Bitcoin exposure through a regulated stock. That premium lets the company raise capital. That capital buys more Bitcoin. More Bitcoin means higher stock price. Higher stock price means more capital. The flywheel spins forever, except it stopped spinning. In December 2024, Wall Street valued strategy at 2.5 times its Bitcoin holdings. That premium reflected confidence. Confidence in Saylor, confidence in the model. By late 2025, that premium collapsed to 1.16 times. Today it is hovering around 1.02. You understand what that means? The market is now saying strategy is worth almost exactly the same as the Bitcoin it holds. No premium for the strategy, no premium for Saylor, no premium for anything. And if that number drops below 1, the entire model breaks. But wait, it gets worse. Fortune reported on January 2nd that Strategy's market cap is now $47 billion. The Bitcoin it holds is worth $59 billion. Read that again. The company is trading at a 20% discount to its own Bitcoin. Why would anyone buy a stock that gives you less Bitcoin exposure than just buying Bitcoin directly? They would not, unless they are trapped in index funds that are forced to hold it. And that is exactly what is about to change. January 15th, 2026, 11 days from now, MSCI is deciding whether to kick strategy out of its global equity indices. Here is why that matters. Trillions of dollars track MSCI benchmarks. When a stock is in the index, passive funds have to own it. When a stock gets removed, those same funds have to sell. Not because they want to, because the rules force them to. JPMorgan ran the numbers. If MSCI removes strategy, $2.8 billion in passive outflows hit the stock immediately. If other index providers follow, and they usually do, the total outflows could reach $8.8 billion. $8.8 billion in forced selling, on a stock already down 66%. That is not a correction, that is a liquidation event. Now here is where the anti-establishment angle comes in. MSCI's new rule says any company with more than 50% of assets in digital currencies is not an operating business. It is an investment fund. And investment funds do not belong in equity indices. Think about what that means. They are not saying strategy is a bad company. They are saying a company that holds Bitcoin cannot be treated the same as a company that holds cash or real estate or inventory. Bitcoin is being punished for existing. Saylor built a company that turned corporate treasury management into a Bitcoin accumulation engine. And now the indexing establishment is changing the rules specifically to exclude him. This is not about risk management. This is about gatekeeping. But I need to be fair here. Let me show you both sides. Strategy has $8.2 billion in convertible debt and $7.5 billion in preferred stock. That is over $15 billion in obligations. Their software business generates $460 million in annual revenue. That does not come close to covering the interest. If Bitcoin crashes, the company cannot service its debt through operations. They would have to sell shares, diluting existing holders. Or worse, sell Bitcoin, and this is where the nightmare scenario begins. Strategy holds 672,000 Bitcoin. If they are forced to sell even a fraction of that, the market impact would be catastrophic. FTX held far less Bitcoin and still crashed the market when it collapsed. Strategy holds more than 3% of total supply. One analysis estimated the probability of a full strategy collapse in 2026 between 10 and 20%. Those are not small numbers, but here's the counter-argument. Bull theory pointed out that even if Bitcoin fell to 74,000, the cost basis of Strategy's holdings, the company's Bitcoin would still be worth $49 billion. That exceeds their total liabilities. They have no margin loans, no collateral-backed Bitcoin debt, no liquidation triggers tied directly to price. So, the company is not insolvent, but the stock is trading like it might be. Here is what the smart money is watching. January 15th, the MSCI Decision. If they exclude Strategy, expect immediate selling pressure as passive funds rebalance. Polymarket currently shows a 77% chance that Strategy gets delisted from MSCI by March 31st. 77%. The market is betting against Saylor, not because Bitcoin is dead, but because the structure he built is being targeted by the same institutions that claim to support innovation. Now, let me tell you what this means for you. If you own Bitcoin directly, you are fine. This is a Strategy problem, not a Bitcoin problem. But if Strategy is forced to sell, the supply hitting the market would push prices down temporarily. That creates buying opportunities for patient capital. If you own Strategy stock, you need to understand the risk. This is not a Bitcoin bet anymore. This is a bet on whether the indexing establishment will let Saylor stay in the game. And if you are watching from the sidelines, the January 15th date is your signal. Whatever MSCI decides will set the tone for crypto treasury stocks for the rest of 2026. Here is the bottom line. Michael Saylor built the most aggressive Bitcoin accumulation machine in corporate history. 672,000 Bitcoin, $50 billion deployed, 3.2% of total supply. But the same leverage that amplified gains is now amplifying losses. The stock is down 66% in 6 months. 90 billion in market cap erased. And in 11 days, MSCI could trigger 8.8 billion in forced selling.